Welcome to a new episode of the Startup Show. Today I have the big pleasure to meet with Jeremy Cohen, founder of Simplewealth. Welcome to the show.
Thank you. Welcome for having me.
So welcome back to a new Startup Show today here with Jeremy Cohen from Simplewealth. As usual on the Startup Show, I want to hear a little bit about yourself first. So give us a little bit of an introduction about your career up till now.
Sure. So I'm Jeremy. I'm from Paris. I graduated as an engineer and then I joined McKinsey as a consultant. I wanted to travel a bit around the world, see many different things. I ended up working with a lot of banks and investment banks and retail banks, helping them on a lot of questions they may have. Then I joined UBS in Zurich, where I was working for the wealth management arm. And I also worked a bit and traveled a bit in Asia and saw a bit different client segments. So very rich, like quite rich. and that's where I had the idea for Simplewealth, like in the quite rich segment, which is people who are like below 1 million of a franc or for US dollars. The service UBS provide and the service the banks provide is becoming very hard to do with the current setup. Like having an advisor who tries to answer all your questions you may have and having also a full attention to your portfolio is becoming a lot more costly with all the compliance costs, all the competition which comes there.
So before we get, I want to hold, because I want to get to know you a little bit better. I want to introduce you a little bit to the audience because I know you, I know exactly everything, but they don't know yet. You made this shift from corporate to, or you are about to make this shift from McKinsey, UBS into a startup. Tell me why. Why would you do that? What motivates you to make this shift from, let's say, steady income to high risk?
You see the immediate impact of your actions, and that's a lot more exciting. That's something which is very, very exciting.
So that's what excites you about the entrepreneurship, the fast-moving, and I guess you didn't see that without naming any companies as that's different to the corporate world.
It's a different scale because when you want to move things with a 60,000 people company, you need to organize a lot, and you have massive firepower. But this whole organization takes a lot more time and a lot more effort because you need to align 60,000 people into one direction. Yeah. If you are 500 or if you are 4, it's a very different question. You have a much less firepower and you need to be a bit smart on how you use your resources. But the alignment and the direction you get, you see immediately the impact.
Okay, so let's get into Simplewealth. What you guys do exactly? So give me your elevator pitch or your pitch, like what you usually.
So the idea is like, currently, with the money you earn, you have 4 ways to invest it or to save it. Like the first one is you leave it in cash in your bank account, right? The second one is you go and see private banker, but usually have quite high fees and quite high minimum amount of wealth. So 250,000 francs, that's a minimum you would get. And a lot of clients don't have that. And then you have also another option, which is trying to invest it by yourself. So you go into the Saxo Bank or the Swiss Quote and try to invest your money by yourself. But it's a bit of a casino approach because sometimes you may win, sometimes you may lose, and you don't have the whole portfolio view that a professional wealth manager would provide you. Yeah. The fourth option is actually you spend it. You travel around the world and you enjoy it, but then you don't save for your future, right? With Simplewealth, what we're trying to do is to offer the service of a wealth manager, so a managed portfolio with professional research backing up the investments, and at the same time, low minimum amount. So we start at 5,000 francs and relatively low fees. Like if a UBS in the affluent segment would charge 2%, for example, we would charge 1%. From that, you can invest for the long term, starting low and then growing over time.
Let's make it very simple and very clear for me and my audience. So let's say I'm 27 years old. I have some savings. Let's say I wish it was 100,000. Let's say I have 100,000. How do I use your platform now?
You go on our website. We are going to ask you a few questions around how old are you?
Know your customer.
Who are you? Exactly. And also what your investment objectives are. Do you have something like in 3 years? Do you have something in 5 years, in 10 years?
Such as buying a house or a wedding or...
Exactly. Yeah. Do you plan to have kids in immediate now, or do you plan to wait a bit? And as such, your risk profile and your investor profile is going to be different from that. Yeah. So we build this whole investor profile from the questions we ask you. And from that, we create a portfolio for you based on those questions. And then you open an account at our broker, and we give orders to our broker to invest that money for you. And we watch over that money 24/7. Our algorithms are not sleeping on that matter. And as soon as we see that what's invested doesn't really match the profile we discuss together and we define together, we ask our broker to rebalance that and to go back in line so we can have the best return over time. That's a theory called modern portfolio theory, which emerged in the last, let's say, couple of decades. And that's a theory which proves that you can have consistently return by diversifying your investments.
Right.
You have two options. Either you invest everything on one action, but that's risky. On one stock, but that's pretty risky. Or you try to diversify your risk as much as you can.
And then Markowitz, what's his name?
Exactly. Harry Markowitz. That's exactly his theory.
He won the Nobel Prize. So
he won the Nobel Prize for it.
Diversification of companies and industries and countries. So that's very interesting. Give us some number crunching in terms of return. What can investors expect?
So it's very dependent on your profile. So if you have a very not risky profile, risk averse, and you want to basically stay and preserve your capital, you can expect something like 1% to 2%. Obviously, that's what we backtested over the last 3-4 years. I must say that past performances are not an indicator of future performances, but over the last 3-4 years, that's what we looked at for the less risky ones. For the most risky ones, if you look at investing in emerging markets, in commodities, on European stock markets, on US stock markets, you go to significantly higher, between 6 and 9%. But again, with a higher variability. But over 3, 4, 5 years, on average, you get to 6 to 9% per year return.
And how do you pick the stocks that are within your portfolio?
So we looked at the past 20 years. We looked at the indices, how they're correlated with each other. Like when one is going down, how is another going? Is it going down, going up? And the modern portfolio theory tells us that when one is going down, what you should buy is not one who also goes down, but one who goes up. So they are not correlated together.
Okay.
And then you can diversify and reduce your risk. So we looked at that over the past 20 years. We looked at indices which are consistently working together.
Yeah.
And we did an optimization based on that. We also did a bit of research on what mega trends are we seeing, and also that's how we build them.
Right. We discussed a little bit beforehand that we want to discuss like this last part of the video about the issue that we have as young people, that we want to save money.
Yeah.
And it's very hard because back our parents told us, cash is king. So you put the money in your bank account, you wait a few years, you accumulate interest. And then by the time you retire, you should have enough money to.
Yeah.
It does not work today.
Like
it doesn't work. The more money you have, the more you pay.
Yeah.
It doesn't work.
Yeah.
So I would like to hear a little bit from you. What your strategy is that, like, let's say we can retire at some point in, I would say 30, hopefully earlier, but let's say 30 to 40.
The earlier the better, right?
The earlier the better. But let's say by age 60, 65 that we can retire. What should be our money and investment strategy be?
So I would say there are two categories of people in that. Like there is one way where you say, my money is mostly going to come from my work, and so from my career, or my money is mostly going to come from other sources. Let's say inheritance or other things. If your money is going to come from other sources, we are maybe not the right target. But if you intend to make most of your money from your career, then there is a question around trying to invest early and trying to invest with a long-term horizon. And based on that, you don't need to invest a lot per month if you do it for 10 years. It's actually better and safer and also less painful to invest over 10 years, 300 francs per month or 500 francs per month, like save them, put them aside, and invest them on something that brings you significant return, not a classic current account or savings account. Yeah. That's one thing. Than putting a lot of money for 1 year on something very risky. Over time, returns compound. Yes. And that's a lot more powerful than a 1 year stint. Because it can work one way, it can work the other way, right?
Sure. No, but I mean, like it's. I think where many people struggle with, going to the stock market. It's a lot of times it's like the gambling experience. You don't really know. I mean, like I study finance, so I know about Markowitz. But like I say, like the most of the people, they say like, oh, I like Tesla, sounds cool.
Yeah.
Let me buy some Tesla stocks, but they don't realize that Tesla is probably highly volatile and it's not so clear where they're going. And they will be maybe much better with, let's say, Swisscom stock that gives like yearly dividends and it's always clear. In terms of strategy of someone who is, let's say, starting off his career, what should you do? I
actually believe less in stock picking and more in index picking. instead of saying, I want to go Tesla, I want to go Nestle, Novartis, you actually should rather go, do I want to go Western Europe companies? Do I want to go American companies? Instead of saying, I want to bet all on one stock or all on a handful of stocks, you have more consistent and less volatile returns if you bet on an index, because the index is made of 30 stocks already, right? And as such, it's going to be dependent on how the whole region is performing, and not if you have, let's say, a significant event somewhere, like a Tesla crashes tomorrow. That really means something for Tesla, right? But if you say, I'm looking at all the American large corp companies, then you will have a consistent return over the years. So beyond stock picking, it's rather index picking. And what we have done at Simplewealth is looking at how several indices are performing within each other.
Right. Cool. It's very interesting, and I think we could discuss it for a very long time. I want to wrap the show though with one last question about your experience with handling a corporate job together with building your own startup.
Yes.
How does that work? How do you combine that?
I think the first thing is to be clear versus the employer versus the owner. The first thing I mentioned to them is, by the way, I have this side project.
Communication.
Which is important for me, and that's like, exactly, being transparent, clear, and honest on that is like the first step. The second step is actually your employer wants you to succeed in all dimensions, right? And your employer can also help in some areas, right? And so being clear, transparent, and honest, and also leveraging what you learn in your startup world or in your small side project within a corporate environment brings a lot of value to your employer, because entrepreneurship is a lot of hustling, right? Like you need to find a way to find your ways around and find your good ways around. And in the corporate world, you also need a bit of hustling, actually. And having good ideas and bringing good ideas to the table is always valued.
For sure. I mean, that's a perfect wrap for the show. I think it's really clear that, like, you know, open communication with the employer, there is a chance that even if you're working in a corporate, you can start your own company, which is really great to see. So, Jeremy, thank you very much for taking the time to be on the Startup Show. Guys, thank you very much for watching this episode, and I'll see you very soon with a new episode. Have a good day.